Hi, this is Alex Byer again, and just wanted to go over a couple more things about long-term care and the planning. So in California, we have certain rules, and the government's willing to help us through the Medi-Cal long-term care program for people that qualify based on the assets and I won't say the qualifications having to do with the income, but the income plays a role in what the benefits that you'll be able to get. So in California, through the Medi-Cal program, the Medi-Cal will actually pay for the care, often sometimes between $11,000 to $18,000 a month is what it costs to get into a skilled nursing facility or a care home. And in order to qualify for that, generally they'll tell you just to go spend down your assets once you have something. It changed a little bit last year, but once you have something around $2,000 in the bank, then come back and talk to us. We'll help you pay for your care. And most people can't do that. But after doing certain things and certain planning where we get assets, we transfer them, we do some gifts and move some things into other entities, and we're able to have the specific amount of assets in the bank account to help qualify for Medi-Cal. Then we're able to make application, and our clients are able to get those benefits that they need without losing everything. They don't have, and they still are benefited by the assets potentially that they had previously. So in order to qualify, what Medi-Cal requires that previously, most of the programs through Medi-Cal and through the government, many of them, they require that you have about $2,000 or less in the bank, which, hopefully most of us have more than that. Last year, they actually increased it so that there's more assets that you could have, and we'll see how that turns out. They're planning on changing it again. We'll see how that turns out in the long run and how that affects Medi-Cal recovery, which is another thing that we need to figure out, make sure that they don't come back and try to take our house after care is given, and they don't try to take any other assets that we have. And there's ways to get around that. None of our clients lose their houses when we do any of this planning for them. But when you qualify for your assets and you have a specific amount of assets, then you can make application, and you make application by letting Medi-Cal know what your current assets are. They want to go back and they want to see a number of months of bank statements. They want to see what the transfers were, if there's any large purchases, why these transfers were made, if there's anybody else's names on the account, why are these other people's names on the account, are they joint owners, are those assets available? These are things that after going through and looking through the bank statements and things, we can figure out and what needs to be done with those assets, whether there's things that have to do, special rules that have to do when you have retirement accounts, that we can make it so that the retirement accounts don't count as assets anymore for qualification of Medi-Cal. There's things that you can do if you have rental properties or other bank accounts, things to do with your house so that your house won't be subject to Medi-Cal recovery. A house is something that generally, if you have it submitted the proper way, then your house can become an exempt asset, so it's not something that will count towards the asset qualification under Medi-Cal. And you can own things like a car. You can have retirement accounts if they're under distribution. You can have a burial policy. You can have certain types of life insurance, depending on the amount of the face value. And if there's a cash value, there's certain things that you have to do. If there's annuities, there's certain things that you have to do. If you have other real property or other vehicles or personal property, and there's certain things that we have to do. And generally, once we do that type of planning, we work with the family, and we can make it so most people are going to be able to qualify for Medi-Cal. And in some cases, when people have, lots and lots of money, then there's ways that we just we can transfer the assets, and then after a period of time, then after a certain number of months that they self-pay, you can go in and get those benefits afterwards without having to lose everything or spend down everything in order to do that. So that's the first way to qualify for Medi-Cal. The consideration is the share of cost. And with the share of cost, there's a number of different programs that have a little bit of their own rules, but in basically your income, what's in your name, is going to be a part of your share of cost, less about $35 that they let you keep to buy your toothpaste and things like that. So there's certain things that we do depending on how the payments are being made, if they're income, if it's from retirement, if it's from Social Security, if you have other investments where those incomes are coming from, can they be changed? Can they go to the spouse? Because if there's a surviving spouse, if there's two people still around, then there's ways to transfer things to give to your spouse. They can have a certain amount of income. They can have a certain amount of assets that won't disqualify the recipient of benefits to be able to get the Medi-Cal benefits, so that the spouse doesn't have to also become impoverished in order for somebody to get those benefits. So those are some of the things that we need to consider. What are the assets? What can we do with them? And what is the income? What are the sources? And how do we get those either transferred, or how do we deal with those so that somebody needing the care from Medi-Cal can get that care?